that talks about the power of indicators. In fact, it uses GDP to make that point, saying that without measures of economic aggregates like GDP, policymakers would be adrift in a sea of unorganized data, which kind of, for those who are familiar with the space, describes the biodiversity world today. It's a sea of unorganized data. And when I talk, you'll see a bit about what I mean. And they go on to say that GDP and related data are like beacons that help policymakers steer the economy towards the key economic objectives. Okay, so it's a debate as to whether GDP is a good indicator to identify the best policy objectives for the betterment of society. That's a separate point. But the point they're making is that you need this. If you don't, then you've got policymakers adrift in a sea. So there's quite a few indicators which are considered relevant for the world of ecosystems and biodiversity. How do you make sense out of these? Well, broadly speaking, there are three ways of classifying all these indicators. So one way is to look at which space of human well-being are they impacting? Is it more in the economic side, more on the social side, or more on the environmental side? And of course, there's a kind of Venn diagram which you can draw which covers these. And if you look at the sort of cross between economic and environmental spaces, there's of course not very much unless you go into the green GDP and genuine savings space. HDI is sort of kind of touching upon the crossover point between all three, but not really. It's mainly between social and economic. And then you've got various indicators which are purely social indicators. You've got green GDP and inclusive wealth, which inclusive wealth is sort of in the center space. Green GDP is more in the space between economic and environmental wealth. And then you've got this whole armory of indicators which is available for measuring ecological and environmental factors, including the CBD indicators, the SEEA indicators of the European Union, the red list indices, the footprint, and so on and so forth. A second way of cutting the same population of indicators is to not say like which area of well-being are they addressing, are they measuring, but rather what are they like? I mean, what kind of indicators are they? Are they single indicators? I mean, do they measure something like CO2? Are they basket indicators? Are they composite indices? Are they national income account related? So that's another way of classifying them, rather in the manner in which they measure or what they measure as against the area which their measurement can impact. And yet a third way is to look at this whole idea of drivers and pressures. In other words, are they helpful in measuring the state of ecosystems and biodiversity, or are they more helpful in identifying what are the pressure points and what are the drivers of loss of biodiversity? Or are they actually measures of policy response? What's been done about it, and therefore what is the impact of what's been done about it? So you can classify it in that sense as well, and then see whether they are more about pressures or drivers, whether they're more about responses or the state of biodiversity. And the reality is, in fact, that the whole space is complex because you have to see what indicators are used for, and that's perhaps the most important question to ask, like who uses these and why? What are they used for? So you'll find, for instance, red list being used a lot in the scientific community in terms of identifying extinction approaching species and so on. SEEA indicators are used a lot in managing, especially in the European Union, not surprising. Then you have a whole host of indicators like the footprint and the human development, which are there in the space of public discussion, but also being used in terms of goal setting and policy making. And then finally, there's a lot which goes into just pure analytics and good research papers. So there are actually different users and different uses for these indicators as well. The overall numbers are worth measuring at two levels. Once again, you need to recognize that the adjusted GDP is a result of original GDP plus the incomes that you've not accounted for minus the depreciation that you've not accounted for. Sometimes one compensates the other exactly. Sometimes it's higher, sometimes it's lower. So if you want to get to the truth, you need to know both the changes in flows that you're not accounted for and the depreciation in stock that you're not accounting for. And that's why it's important, and you can see these in the two different colors of yellow. And the fact is that if you look at capital losses, we are talking about stock adjustments across the whole of the country at minus 9% of annual GDP. That's one hell of a big number. 9% of India's GDP, we're talking about $100 billion plus even at that time. That's a huge amount of stock loss to take place during this accounting period, 2002, 2003. And of course, compensating there is some income as well. So it's not just one-sided. But the fact is, the flow adjustments are small compared to the stock adjustments.